Thank you so much, Nisa. We have two really amazing guests. Mona is from Melonport and Avant-Garde Finance, and Daniel is from DiversiFi. Mona, would you please tell us about the amazing Melonport project?
Sure. So so it's been a while now. I first got into this space 5 years ago, 6 years ago now, and it was really after quite a long time in traditional finance. So I started my career in London on the trading floor of Goldman Sachs. I was market making there and prop trading for nearly a decade, and then moved to the buy side and worked for a large European hedge fund running long short equity. In 2014, I was offered some seed capital to launch my own long short equity fund, and I was extremely excited about that, jumping up and down at the opportunity, very naive too, and took this opportunity. It was a $20 million seed, so it was pretty small. And that was probably one of the most challenging career years of my life, because for the first time ever, I was faced with the realities of how the fund engine works in asset management. All the inefficiencies, all the lack of transparency, friction and complication. And all of that was previously hidden from me, because at Goldman and at the hedge fund I worked at previously, we had scores and scores of operational staff to take care of these things for us so that we could just focus on the investments. So after a year, I decided to shut this down and really tried to take a year out and recharge my batteries. And I kind of was sitting on a beach doing just that, in 2015. And I came across an article on Bitcoin, and then that led me to Ethereum. And 5 years ago, I kind of thought, wow, Ethereum is pretty amazing, because what it opens up is the possibility to tokenize assets. And it's so much more efficient than how we do things on paper today. And why wouldn't, if you can tokenize, if you can tokenize companies, ICOs, why wouldn't you be able to tokenize everything? And why wouldn't everything eventually have a tokenized share class? So that became my pivotal, aha moment, where I was like, okay, so if you have a future where everything can be tokenized or have some form of tokenized form, you could also automate all the pain points of finance into a in a smart contract based system. And so that was really the beginning of my journey. Melonport was a company I co-founded in 2016. We did one of the first ICOs, quite small actually, in February 2017. We built V1, or the first version of the Melon protocol, the completely decentralized asset management protocol, which enables anyone to set up a fund and customize it in a matter of minutes. You don't have to be technical. And also anyone to invest in that fund takes care of the NAV calculations, the fee calculations and distribution, all your risk management policies, et cetera, et cetera. So really the manager, all they really need to do is focus on investing. And that was really what I wanted to do, bring simplicity back to the manager and empower them.
And I think what a lot of people don't quite think about is, first of course, the journey of automation is nothing new. You don't have to be decentralized to automate. But the other issue, of course, is kind of platform dependency, because if you jump on a Goldman platform or a Boni platform, if the relationship goes sour, you're out of business. And effectively what you've created is an unstoppable platform. Therefore you just eliminate the risk of an asset manager that the platform that they rely on is going to be removed from under them. And I think that's a lot of the time people don't quite understand how vulnerable a business can be if they rely on a platform that's just whipped away from them. And it happens more often than people imagine. So I think that's for people who've been on the other side, that's pretty amazing. And through decentralization, you create enough trust that you don't have to have the big name of Boni or State Street or Northern Trust to operate that. So I think that's quite unique. Thank you for that. And I guess, Dan, love to hear your story and kind of how you came into this.
Yeah, sure. So my kind of career journey, I guess begins in a very classical way. After studying engineering at the University of Cambridge, I went into the world of business consulting, where I joined kind of like a leading consultancy firm here in the UK, and went into a whole variety of different businesses and kind of helped them achieve their business goals. And I got an opportunity to join Bitfinex, which at the time was kind of growing quite quickly, and could have used my help. And that's kind of how my crypto journey began. Then within there, I quickly moved into Ethfinex, which was kind of a subsidiary of Bitfinex, which was started with the idea of exploring Ethereum, like basically only focused on Ethereum, exploring decentralized governance, decentralized trading, with the idea of that kind of blossoming one day. A few of us from Ethfinex spun out and started what is now DiversiFi, where again, kind of looking into the future, Ethereum, one of its biggest problems was scaling, and especially for trading. Even 6 months ago, it was at times painful how slow the network was, and there were issues with privacy, which a lot of kind of big professional traders and institutions were just not keen on the fact that your trading activity is all public and people can reverse your algorithms and so on. So that's when we started thinking about how we can scale this, and eventually went with the Starkware scaling solution that we managed to launch the new and kind of shiny version of DiversiFi in June, which now allows us to be kind of abstracted from, not completely, but to a level abstracted from the congestion of the network.
Yeah, I mean, I think it's amazing because one of my personal hypotheses is the fact that, lack of trust creates fragmentation of liquidity. Yeah, because, you might say, for instance, I'm not going to trust more than X to a particular exchange. You fragment your liquidity, but that drives your costs up because you're now managing rebalancing, you're actually kind of missing some of the trade opportunities, and you're not getting access to that huge liquidity. Then you go OTC because now you have to source liquidity, which adds the brokerage fees, and et cetera, et cetera, et cetera. So in reality, if we get it right, then by significantly improving the trust relationships through decentralization, we can create massive liquidity pools that kind of effectively creates deeper and cheaper trading. That's kind of hopefully the game.
Yeah.
So I guess in terms of then, both of you went from centralized, whether it's traditional or crypto space, into more in deeper into the decentralized. I guess just really love to say what you think you've done wrong so far, and we can, what are the insights about what we've learned we can do better. And then also, frankly, almost like, well, quite a few folks are now coming from centralized finance and they're unhappy with their returns right now and so on. They're like looking at DeFi and saying, this sounds good, but I'm a little bit nervous getting into it. Sell to me why I should go into DeFi, but don't give me all this BS around decentralization. Sell it to me as though it's a business proposition, unemotionally.
Okay, so first of all, I want to just make something very clear. There is a spectrum of decentralization, right? It's not that you are either decentralized or centralized. And there is also on that spectrum a trade-off. The more decentralized you are, sometimes the less efficient you are. Decision-making is slower. Results can be slower. And so it only really makes sense. The more decentralized you get on the other side, the more secure a system becomes, and the less subject to attack or malicious attack or failure a system is as well. So you need to think very carefully when you're looking at the space. It's not just, we're kind of at this one extreme. But I want to make it very clear is there's a spectrum, and it doesn't necessarily always make sense for everyone to decentralize everything. And so the way we have built Melon at its core is such that at its purest form, it is totally decentralized. But if you want to centralize certain components for efficiency or for whatever reasons it might be, maybe you want to set up a type of fund that needs to have certain regulatory conditions, and so you have to centralize certain parts of it. You can still customize it to be that way. In the asset management case, you'll know as well as I know that it typically costs at least $100,000 to set up a fund. And probably at least $75,000 of ongoing costs recurring per year to maintain just the basic fund administration, custodian costs, etc. So in terms of what a protocol like Melon could do is taking that cost to literally a couple of $100, its rawest form, of course, and then no recurring costs over that. You would just have to pay for trading, of course. So that's for me what was, I mean, coming from my fund failure, that was what was really exciting for me. Essentially, you democratizing finance, you're empowering people, who love investing to focus on just the investing component. But it's, DeFi is very composable. You can mix and match it with many different, other protocols. You can, moving to your next question, which is, what about the returns in DeFi? A lot of them are irrational, I'm not going to lie. And some of them are rational. There are some very exciting things happening. You can earn yields which are not possible to earn on, for example, you can earn up to 6% interest on a digital dollar, lending a digital dollar today, and you can't a decentralized digital dollar, which you can't do in traditional finance.
Dan, same for your question.
So what's the most interesting, like what is driving people to DeFi now? So as we already mentioned, there is a lot of capital flowing into DeFi, and that is mostly prompted by big returns. Now, as always, big returns come with certain risks, and there is a reason why they're there. Now, generally, why there are such big returns in DeFi is basically because people are incentivized to use certain products, and there is a level of hype there. There is there now. However, I think there are also a few positive things about DeFi compared to kind of hype cycles in the past. The first one being that there is a lot of hype around things right now, but it is generally all around existing products. So things are hyped, but that is because there are real things that work and they create some value. Now, people speculate that value is higher than it is, maybe, but it's not just a white paper. In terms of security, I think, again, everyone has to do their own research before putting in significant funds into anywhere. But I think over the last year, DeFi has kind of matured quite a bit in terms of kind of like auditing practices, but also in terms of disclosing vulnerabilities. I think there's now an expectation in the industry of how these things are disclosed, rather than kind of people keeping it quiet and trying to hide the fact that there's vulnerability. There's a lot of there's a practice of openness, and that's almost expected, and there's kind of a bit of forgiveness if you do it in the right way. When we boil it down to where does the non-hype value in DeFi come from, and it is mostly around kind of the types of things Mona mentioned around cutting out intermediaries. So when we cut out intermediaries, a lot of extra value is left to be taken by other participants in the value chain. So if you're not paying $100,000 for your fund, those $100,000 are left either for you or for the investments you're making.
Yep.
Maybe, if I can just jump in, Alex, maybe as just a little cool analogy, the way I sometimes like to think about it is Bitcoin was the first example of a public blockchain we had. And then if you think about Ethereum or the protocols in DeFi that are happening on Ethereum, you have things like trading, which DiversiFi are in, and that could be and when you're trading, you have a buyer and a seller, and normally you need a whole host of intermediaries to make sure that the buyer and seller, when they agree on a price, the underlying asset is exchanged. So you need the exchange, the guys that change the ownership of the transfer agent, et cetera. And now you can basically do that with a few lines of code, and the blockchain enforces that settlement almost immediately. With lending protocols, you have borrower and seller. And, when you borrow, you want to make sure, or when you lend, you want to make sure that the borrower is going to pay you back. And that's what those protocols enforced, without the need for, usually you would have a bank, a credit agency, et cetera. Yeah. And the protocol is really enforcing you know, that process without the need for a financial intermediary. So all of these, and asset management is the trust between the fund manager and the investor. So like there are parts where it's gameable and it might not work, etc. But generally speaking, you know, the number or the number of tasks left that need to be monitored are greatly reduced, and therefore the cost of operating in theory should also be greatly reduced.
So thank you so much.